Last spring, I warned that America is trying to break us so they can own us. And I promise that that will never, ever happen. We are keeping that promise. Canada is becoming stronger and less dependent on America. We are already giving ourselves more than they can take away. And we are just getting started.
Fighting words from Canada's Prime Minister after trade talks collapse and the U.S. slaps 50% tariffs on many of its exports. Mark Carney says his government will retaliate as it digs in for a trade war that could last beyond the U.S. midterms in November. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. We'll get perspective on the North American trade war with someone who's been in the room during previous high-stakes negotiations. Former Canadian Trade Minister Mary Ang will tell us whether this new fight means the beginning of the end for the USMA-CA Pact. AI funding in focus with Alibaba's shares tumbling in Hong Kong after it raises $10 billion in a share placement. Bloomberg Intelligence on deck on the immense cost of a high-risk AI strategy. Also ahead, insights on Indian markets with Dhiraj Relli, the CEO of HDFC Securities, with the rupee in focus as the diaspora pours $65 billion into special deposits. And Singapore's Prime Minister announces sweeping support for families as the Lion City grapples with a record low birth rate. We'll ask whether the measures can stop it becoming a super-age society as soon as this year. Our top story today, U.S. and Canada relations hitting a fresh low following the collapse of crucial trade negotiations. The Trump administration slapping 50% import tariffs on items such as plywood, electronics, and even hockey sticks. Canada, for its part, is planning counter tariffs on $20 billion worth of American products. Prime Minister Mark Carney's top U.S. envoy telling Bloomberg the talks broke down over the fine print in the deal. President Trump, meanwhile, says Canada wanted the benefits of being a U.S. state without becoming one. Let's dig into all of this with Bloomberg Managing Editor Jill Deesis. And Jill, our reporting suggests that Canada expecting a long trade war. Tell us what that is all about.
Yes, that's right, Haslinda. So this is according to people familiar with the matter. Mark Carney has warned that he suspects that this could continue to happen, could continue to be an issue through the U.S. midterms later this year in November. So, I mean, you're looking at something that is, indicates that Canada is gearing up for a protracted trade fight with the United States, while both sides haven't really ruled out the idea that they could come back to the negotiating table at some point. At this point, we don't see anything imminent. Obviously, you've got that news of those U.S. tariffs already. What Canada is planning are retaliatory tariffs to go into effect on September 8th. We're still waiting for more details on that point. But yeah, I think at this point, Haslinda, it's safe to say, obviously, you've got these talks breaking down on late Friday, and now you do have this threat that we could be in for that protracted trade fight.
So no new talks imminent. What now? What's the path forward for Canada and the U.S.?
Well, I think at this point, Haslinda, you have to imagine that while both sides, they do still seem open to the idea of reviving talks at some point. So maybe you do see something there. I will point out, though, that, to your point about the Canada saying that these talks fell apart over the fine print. I mean, we had the, Canada's ambassador to the United States kind of, describing this as, a handshake deal for a house. And then you take a look at some of these issues and see that, the other side is bringing to the table things that, sort of negatively impact you. It does seem like vehicle tariffs in particular were a sticking point between these two sides. So we'll have to see whether or not they're able to actually come together and reach some kind of a lasting agreement over those topics in particular.
Jill Deeses, Bloomberg Managing Editor, thank you so much for that. Let's bring in our guest. Mary Ng was Canada's Minister of International Trade under former Prime Minister Justin Trudeau. Mary, good to have you with us. I mean, when you take a look at the collapse talks, is it a reflection of possible missteps by Canada's negotiating team, or is this just a U.S. that's unwilling to compromise?
I don't think it's missteps at all. I mean, Minister LeBlanc, who is in charge of the Canada-U.S. trade negotiations, along with the chief negotiator in Ms. Janice Charette, are very seasoned ministers, and Ms. Charette was the clerk of the Privy Council. I've worked with both of them. The trade negotiating team are excellent people, along with the ambassador. And what Canada was going to the table with was a fair deal with the United States. And they've been working very hard and diligently at that. We were staring down 50% tariffs that were coming in, and we certainly wanted to work hard to make sure that those didn't come in. But also at the same time, the Prime Minister had directed the negotiating team to get a fair deal, and that didn't happen. And as a result, the Prime Minister recalled the team back to Ottawa.
So, in a way, it is not surprising. Do you see this perhaps as a permanent shift in U.S. trade posturing?
It is already a permanent shift. I mean, you've heard this from Prime Minister Carney earlier this year, and consistently. We don't see the United States valuing the integration of our markets that we have developed for decades that have benefited both Canada and the United States. Canada is the top customer to 25 or 26 states. We're among the top 3 customers to over 40 states of America. So we are a terrific customer, and the integration that we have built over many years that have benefited, that have created affordability for Americans, that have created a very strong trading relationship. We don't see that relationship anymore. At the same time, we do have a trade deal. We have the USMCA here in Canada. It's called CUSMA. That trade deal is in effect. And what we were trying to do in this period of time was to negotiate something fair that was going to work for America and certainly work for Canada.
Mary, interesting that you brought up USMCA. USMCA was put in place precisely to prevent this kind of tariff escalation. Are we seeing the beginning of the end of the USMCA?
Well, that would be a process. I mean, the USMCA is intact right now. I would say that the United States has violated that trade agreement. That agreement precisely is, was negotiated by President Trump in an effort to strengthen the North American relationship. The new 338 tariffs, which the president has recently issued under a law that was dating back to 1930s, the Hawley-Schmoot law, that has enabled the president to issue these 50% tariffs. But from our standpoint, they are unfair, they are unjustified, and they violate the USMCA as it stands. Having said that, we still do have the USMCA, and that does still provide some kind of framework for Canada. But as Prime Minister Carney has said, we have continued, from the beginning of his term, he has sought to create Canada strong, to create, control the things that you can control in Canada, create more diversification with other countries and other nations who are good trading partners with Canada, attract investment to Canada. And Canada is seen as a very excellent trading partner and an excellent investment destination. Those are some of the things that we can control, and those are the things that we are diligently working on as Canada.
Obviously, the U.S. can't be controlled even by USMCA. I'm just wondering the viability of having this in place, given that one of its members has already broken the agreement.
We're going to have to work in what is really a new environment for not just Canada. I mean, Canada has seen it pretty much early on in this administration, but I would say that the world is experiencing this as well. Our top priority right now has got to be to protect Canadian workers, our farmers, our businesses, our communities, our families. I know that the government, for sure, having been there myself, is looking at a range of options right now to make sure that we are helping Canadians Canadians through as Canada is also preparing its dollar for dollar retaliations that will come into place in response to this unjustified tariff of 50%. We're going to do our own for September the 8th. So the team is no question hard at work with that top of mind.
Mary, this is a trade war. Is the USMCA or NAFTA, for that matter, still relevant today then?
It is relevant. I think you can do two things. I think that you can operate within a structure and use it for its usable purposes, and at the same time respond to the unfair and unjustified 50% tariffs that are coming in, and ensure that the Canadian government provides the kinds of support or remediation that's necessary for Canadian workers and farmers or small and medium-sized businesses, and at the same time have a game plan for how we respond dollar for dollar in that retaliation that the Prime Minister talked about.
It's not just a response to the U.S., but also a response for the people. What's the cost of these new 50% tariffs, and what do you see the government doing to help alleviate the issue, the stress on its people?
Well, that's exactly what the government is working on right now. I would say that my best guess is that they have been working on that in anticipation of this. I mean, no one wanted to see this, and it would have been terrific if we did not find ourselves in this position. But the government is absolutely working very hard to understand what it is that they can be doing for the affected sectors, because we could see this. This issue going on for some time. So as a result, how do we help our affected sectors like auto or steel, our forestry sectors, the range of small and medium-sized businesses that are affected? We're going to have to look at measures that might provide some assistance to them. I mean, at the end of the day, when this is taking place in our businesses, it affects families and it affects communities. So I know that the government is working very hard to look at what kinds of supports they're going to need to put in place in response to our farmers, our workers, and our people and our businesses here in Canada.
Mary, two things. One, can you quantify the kind of pain, the kind of cost that this will impose on the Canadian government and Canadian businesses? And secondly, realistically, what can the government do? We're talking about a slew of, I guess, sectors, SMEs that will be impacted. It's not just a small number of steel mills.
Well, as an example, I mean, here in Canada, there are a range of infrastructure projects that need to be done. There are a range of, critical minerals, energy projects that need to be done in Canada. There's an entire supply chain that supports, sort of the big sectors, the affected sectors. We can and we are going to look at how we domestically can be helping those businesses here in Canada, just simply by being a customer. As an example, the Prime Minister has a big investment summit coming up in about 3 weeks from now, attracting, I think what he said was asset allocators of close to $100 trillion. These are global investors that are looking at Canada, and those are some of the things that we can proactively do. The Prime Minister and this government has continued the work. You know this because I've been in Singapore quite often in the past, around diversification, looking at other markets for our business to grow into. That, of course, is going to take time, but that is work that the Canadian government, when we say focus on what you can focus on, those are the kinds of things that we are focusing on. And at the same time, we're going to have to look at the kinds of supports that might need to bridge some of these, industries, or some of these support some of these industries and some of these SMEs through this period of time. And that's the work that the government of Canada is doing right now.
You talked about that investment summit coming up in 3 weeks. Do you think the new tariffs would in any way impact Mark Carney's ability to attract investments into the country?
I think that of course, this situation with the United States is an input into that. But as you know, I have just this year become a senior fellow for the Milken Institute, and the Milken Institute is coming into Canada as well for their first Toronto Global Dialogue. The Prime Minister is having his investment summit. There's a range of activities that are taking place here in Canada. What we are consistently hearing from investors is that Canada is an absolutely investable place. We have a rule of law. There are investable projects here, from big projects to a range of incredible mid-market opportunities, from technology to energy to clean technology to health innovation, and then just major projects. I mean, infrastructure projects, critical minerals projects, and others. So I think that the world is bullish on Canada. We've been working hard at that, and we are looking forward to welcoming global investors into Canada.
We've been talking about how Canada has been diversifying. I'm just wondering, on the back of the additional tariffs, would Canada be pivoting even harder towards Europe, towards Asia? What do you think will be done by the Prime Minister?
Absolutely. I think the Prime Minister already said just a couple of days ago that in this fall, he is going to, and his government is going to be working even more intently with the European Union. We already have a trade agreement through CETA that has been in place for some time, where we have absolutely benefited Canada as well as the European Union. And I know that more work is going to be done there around, around security and greater collaboration with Europe. The ASEAN summits are going to be taking place later this year, and the negotiations between Canada and the ASEAN nations, have been going on, and I suspect that that those are moving along quite well. Some of those ASEAN countries are already part of CPTPP, and Canada is enjoying a trading relationship that way, and I think we're going to see a deepening of that relationship. So the answer is yes. Opening up markets and ensuring that there is a good environment for investments for our businesses is what governments can do to create the right conditions and an environment for businesses and for investments to be trading and doing commercial deals together. And that is what Canada and the entire team and the Prime Minister are very focused on doing.
And Mary, of course, you've been part of these negotiations. So far, though, there are no trade talks planned between the U.S. and Canada. What would it take, you think, to bring both sides back to the negotiating table?
Well, I think these talks are iterative. I mean, in my experience, even as, even when talks break down, both sides will go back and they will reflect. I hope that the United States is taking a look here and recognizing that Canada, as their largest customer, top three for over 40 of their states, and this integration that has benefited Canada and the United States and and that tariffs really is a tax on Americans, that they will take a look and reflect on this. We're hearing from American administrators who acknowledge that that trade with Canada is in fact a good trading relationship, a good economic and commercial relationship. But these are iterative. I mean, I would suspect that the teams are going to continue to reflect on this. Should there be an opportunity, they will get back to the table. But I would say that from Canada's perspective, they're not going to take a bad deal. It's got to be a deal that is fair, and Canada will always do it in good faith. But a good deal is what Canada has got to do for its people.
Mary, thank you so much for your time. And of course, we look forward to seeing you here in Singapore in October. Mary Ng, former Canadian International Trade Minister. Still to come on Insight, Singapore ramps up support for families with bigger baby bonuses, cheaper childcare and more leave for parents. A closer look at Prime Minister Lawrence Wong's latest efforts to reverse the country's record low birth rate. Keep it here with us. This is Bloomberg. Singapore's Prime Minister Lawrence Wong has announced a package of childcare benefits to support families as the Lion City grapples with a record low birth rate and rising concerns over the cost and pressures of raising children. Wong used his National Day rally speech to announce that each child will receive the equivalent of about $55,000 in direct assistance through age 17. Bloomberg Chief Asia correspondent Rosalind Matheson joins us now. Ros, just to put it out there, this is not a new problem. It's a long-standing problem. Singapore's always seen the replacement rate below replacement rate for the last 50 years, but it's close to becoming a crisis.
Well, that's right. It's actually hitting those historic lows, as you say, 0.87, which is far below the rate you need to replace yourself on a generational basis. And the government, as you say, has been attuned to this for a long time. If you look back, prime ministers in Singapore have been talking about this for 25, 26 years or more, recognising the challenge. You've got that double whammy that, many countries do, which is a declining younger population, a shrinking local workforce as a result, and a much ballooning elderly population and all the kind of challenges that brings in terms of social economic challenges. And so they're very attuned to that. The question is, what, if anything, can you do about it? At least it seems to be a recognition. If you look back 25 years, it was more about programs that would foster matchmaking, trying to encourage people to meet young and get married, and recognising, that people tend to get married later. So you meet them where they are and you try to get to that point. They are thinking about having children. You're going to make it financially easier for them at least to do so.
I guess the question is, will it work? Because we've seen at least the last 3 prime ministers, implementing measures to encourage people to have more children.
Yeah, it is quite difficult. As you say, the trend remains despite all these policies over the years. But the government seems to be quite pragmatic, at least. You see the comments from Lawrence Wong. He recognises this is not a silver bullet. He's not expecting things to shift significantly in the short term. But over the long term, again, can you just make it easier for people when they're considering having children or having more than one child to do so? And so really the focus of these policies on things like expanding childcare leave significantly. And that's important also for working parents, especially if both parents are working. Now, to make it cheaper, to cut the fees for subsidised childcare, for example, again, make it easier for parents to keep working. Of course, there is the question for companies and all of this, because childcare leave is really going to increase. But the government seems to be saying on a pragmatic basis, in the longer term, let's see if we can just stabilise the rate, if nothing else.
We will begin to see a shrinkage in the population by 2040 if the numbers persist. I'm just wondering if immigration could be the way to go for the country.
Well, it's a question for a lot of countries who have that shrinking domestic population, just in terms of the replacement with babies, is how much can you bring in terms of immigration, and what sectors do you bring them into? Is it very much a focus on skilled immigration, or do you have a highly skilled localised workforce and therefore you need people to come in for other kinds of work? And you see that debate across many countries in the region. I mean, obviously in North Asia as well, Japan, Korea, you see it, not just Singapore. And the government here has been very careful about managing immigration, obviously recognising it's a small, open economy. You do need immigration. The government's very clear about that. But how do you manage that, again, against the needs of your local workforce?
That's right. Competition for jobs, assimilation, lots of issues as well. Chief Asia correspondent Rosalind Matheson there. Still to come, we'll look at Alibaba's $10 billion Hong Kong share sale and Nvidia's plan for AI-related price hikes. Morningstar's Lorraine Tan will be joining us to discuss the impact on markets. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're watching Alibaba after it raised $10.2 billion in Hong Kong's biggest secondary share sale, underscoring its willingness to spend vast sums to take the lead in global AI. Bloomberg Intelligence believes the strategy will keep pressure on returns and result in sustained losses for the company's AI business over the next few years. Senior analyst Robert Lee joins us now for more from Hong Kong. Rob, you got to wonder whether it's raising money because it's seizing the opportunity to do so, or it doesn't really have a choice.
Well, that's a very good question. And yes, Alibaba, let's not forget, is China's largest cloud computing company. So they dominate the industry currently. If we recall back to last week's results, there's very strong top-line growth coming through in the cloud business. And the market is theirs for them to take, potentially, in the long run. But also, let's not forget this is coming at a very high financial cost. As we saw, they increased their capex spending to around $10 billion in the last quarter they reported. They're now in negative free cash flow growth. And the number I've been quoting repeatedly, if you looked at the operating profit in that key cloud division, year over year, the profit on a quarterly basis increased by around $420 million. Yet, as I just said, their capex has gone up to $10 billion in one quarter alone. So the ROI is very poor. This is draining their cash flow. It's pushed them into a fairly significant negative free cash flow position. So I think, as we've been asking continuously over the last 2 to 3 years as we've covered AI, it's all about the bottom line return, not just top line growth. So, and now we've got the share placement, which has clearly taken the market to some surprise, given the dilution and also given the questions it raises, as Alibaba is actually in a net cash position. So why not issue debt? So there are a lot of questions there, but the returns are clearly not going to come through, both in the near term or a medium term basis, regardless of the top line growth.
Surging capex, not new. We're seeing that among all hyperscalers. Nvidia, it comes to mind. It's a price hike. What's that about?
Well, again, the reasons for that are perhaps unsurprising once you understand it's largely a knock-on effect from the bottleneck we're seeing on the memory side. Demand continues to outstrip supply base for their chips and also all the ancillary chips, including high bandwidth memory and mainstream memory, I should say. So as you're aware, there's been significant price hikes for mainstream memory, given the supply shortages in that core mainstream market, and that is having a knock-on effect to them, and they are looking to pass that on to their customers. So as a result, we're going to get heightened capex spending across the sector, not just in the US, but again, that will work its way through here to China.
Rob, thank you. Bloomberg Intelligence senior analyst Robert Lee there for us. Let's get more with Lorraine Tan, Director of Asia Equity Research at Morningstar. Lorraine, good to have you with us. Yes, capex. I mean, let's start with Alibaba raising $10.2 billion. I mean, Mike Burry says he doesn't like the move.
Yes, and the thing is that, they're building and many other people are building as well. And hopefully, people will come. And that's the field of dreams, right? On to the benefit of our view of Alibaba, I guess, it does have an entrenched distribution, has very strong core business still. That cash flow obviously is still positive. What obviously the market doesn't like is the potential for additional increases. And the fact that the pricing is at an 8% discount to the share price also reflects basically, that people are not so keen on this move. The dilution effect itself is quite limited, 3 to 4%, let's say. So if you're a minority shareholder, it's not so much about what's going on now. It's basically what the risks are going forward if those returns don't come in. And that's going to be very disappointing because, this has been a company that has had pretty good capital allocation up until recently.
But valuation is still stretched. It's still expensive, right? I mean, Burry says for him to get back in, it has to drop 50%.
Actually, we disagree with that because we look forward. And we have to have a base case view that eventually we saw this with, for example, Amazon back in, the 20 years ago, let's say. And the fact is that companies build, they are going to run into negative cash flow losses while they build. At some stage, the revenue will catch up with that spending. And then as that spending diminishes, that's where you'll see the explosion in free cash flow, the positive free cash flow comes through. So that requires a little bit of belief. I mean, our base case view is that will happen for Alibaba ultimately because it's got that strength in the cloud business at the moment. And we expect them to be able, given that they are a leader in this space in China, that they will be able to turn that into positive returns.
So have the faith, but when do you dip back in?
That's where it's difficult. I think you're going to, like you mentioned, you're going to see this poor, these losses on the AI side continue for another couple of years, we would say. I know Baba says that they expect things to start improving in 18 months' time, let's say. Well, we expect it to be a little bit more gradual than that. Mm-hmm. But ultimately, within the next these coming 5 years, we should start to expect an improved free cash flow position from the cloud space.
Apart from Baba, how are you assessing the likes of Baidu, Tencent? What's the potential?
Yeah, Tencent is probably we're a little bit more comfortable with Tencent on this front. They are a little bit laggard to it, so unfortunately they will have to keep spending as well if they want to be in this space. The benefit they have is that we expect them to actually get some improvements on benefits from the AI itself activities that they have. So in terms of its core business, the gaming side, we expect the margins for that or the cost of that to improve, to be more diminished in production side. They still have the ability to monetize WeChat if they wanted to on that front. So we think that they have a little bit of flexibility there. They're not nearly a narrow scope, I would say, compared to Baba in this sense. If you ask me about Baidu is in a little bit of a tougher situation because its core business, which is search, is suffering as a result of the competition from AI. So between the three, we probably have a preference for Tencent right now.
The thing is, within the AI space, the concern and the debate still remains about CapEx, right?
Yeah.
I mean, we had from Baba, then we have Hugging Face. At what stage do you really start worrying? At what stage do you think fundraising will outpace, monetization?
So that's the question. I mean, globally, we're worried about the monetization of AI, to be honest, right? Within China, which is notoriously competitive in China as well, you probably got, 300 AI solutions providers coming up. Good and bad. But the good thing about, I think, the Chinese economy and the Chinese policies is that the use of AI is probably going to be a lot more widely adopted or quickly adopted, within China, compared to, let's say, some other countries where it's obviously less, less driven, policy driven in that sense. Yeah.
And in the US, Nvidia still front of mind. The outlook still positive.
Well, the thing with Nvidia, yes, we're still positive on Nvidia. The spend will continue in this space. Nvidia will still benefit from the sales of its chips, for example, and its platforms. The difference with Nvidia is that it basically didn't outperform as much as the tech sector did in the past year. So a lot of that flurry of exuberance went into the chip names. So Nvidia was counter to that, right? So people moved from Nvidia probably to the chip names. So Nvidia, for us, there's still value in the company, and so that's where we think that it's, although the pace, the spend is probably going to peak in terms of growth in 2026. It will still continue to rise, but next year we're looking at a slower pace, and in 2028 an even slower pace as supply catches up as well. So the thing is that we do expect Nvidia to, if you look beyond this couple of years or something, that they will also eventually start to reflect the underlying value of their business.
When you take a look at Nvidia's revenue in particular, that's pretty much driven by hyperscalers, which increasingly are looking at producing their own chips. How do you square that?
Yeah, so that's always a risk. Actually, to us, one of the risks to Nvidia, maybe from our analyst standpoint, is that the relative success of Anthropic, let's say, which uses Google, which uses a slightly different chip, reduces the demand for Nvidia. But we think there's so much activity out there that's still going to drive Nvidia's fortunes.
And closer to home, of course, SK Hynix, Samsung. Today, we talk about how there are concerns about these two stocks, the concentration risk, and so on and so forth.
Yeah.
Given the recent rout, are they out of the woods?
Well, actually, the rout was healthy because it brought valuations back to a much more reasonable level. In fact, SK Hynix went from a strong sell for us, which is a Bloomberg metric, to basically now it's a buy call. Would you buy a memory company at this stage? The peak growth is this year in terms of
SK Hynix's and Samsung's revenue. They will still grow for the next 2 years, but you're not going to get this sort of exponential impact. So the cycle will start to turn down. So although we think, if you look through the cycle, there's still value in the company, but I think in the near term, there's still going to be a little bit of pressure on the share price.
Sorry, so is that a buy or
We
not
have
a
a buy
buy?
for long-term shareholders. Definitely, we still see value, but in the near term, if you're more short-term minded, I think there's still going to be a little bit of volatility and some risk.
Lorraine, let's pull out. When you take a look at the markets, the bond market actually has been grabbing the headlines given surging yields. It's going to be higher for longer for most people as well. How are you assessing the risks that may pose to those AI plays and the risks in the equity market?
Yeah, well, we're seeing it now with the decision to raise shares rather than to raise debt. Where I think, to me, the risk is real. If Treasury yields continue to rise, I think that does begin to basically freeze out some of the investments that are going in. So that's going to result in slower growth all around. As you know, the AI sector is the only segment that was really driving investment growth in the U.S. So that's where the risks are real.
So what's the hedge?
So basically, we on the flip side of it, the good news is that because we think the U.S. economy is slowing, we think the Fed's unlikely to raise interest rates, and that's going to provide a little bit of some comfort to the equity market.
Lorraine, thank you so much for your time. Lorraine Tan, Director of Asia Equity Research at Morningstar. We have some lines to alert you to. New Zealand plans to introduce a new law to ban under 16s from social media. It will require platform operators to check the age of the users. There you have it, the Prime Minister of New Zealand currently on your screen announcing those plans. Again, New Zealand planning to ban under 16 years from social media, saying access is causing harm to a generation of the nation's children. The government will introduce the online safety bill on Monday, today, and that's according to Prime Minister Christopher Luxon, and you have that on your screen. The Prime Minister speaking to the nation right now. Still to come, India's overseas diaspora pours $65 billion into special currency deposits designed to help prop up the rupee. HDFC Securities CEO Dhiraj Relli will be joining us to discuss the implications for the currency, capital flows, and India's banking sector. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, and here's a look at the market open in India. Stocks coming online as the rest of the region sees tech shares under renewed pressure. Indian stocks notched their second straight weekly decline last Friday, with higher oil prices and U.S. bond yields raising fresh worries among investors. The Sensex and the other benchmarks pointing to a higher open, up about 0.3%. And staying on India, the Reserve Bank of India says it's collected over $65 billion in special foreign currency deposits from the Indian diaspora abroad. The RBI says inflows, including overseas foreign currency debt and external commercial borrowing, stand at almost $73 billion. Governor Sanjay Malhotra defended the surprise decision to close the scheme a month early, calling it a data-driven calibration rather than a reversal. Joining us now from Mumbai is Dhiraj Relli, Managing Director and CEO of HDFC Securities. Dhiraj, good to have you with us. I mean, what triggered the change of mind at the RBI, you think?
Happy to be with you. Good morning. I think on a hindsight, if we look at it, Reserve Bank was expecting $50 to $60 billion through the schemes, and they could able to garner almost $73 billion already and $65 billion through the FCNR route. So response from the diaspora have been more than expected. That's probably triggered the RBI to brought forward the closing of the scheme from September 30th to August 31st. I think it's also got to do with the liquidity management at the domestic level, because this deposits get exchanged to the equivalent Indian rupee, and that brings in a lot of liquidity in the Indian market. And also, along with the liquidity, there are concerns on the inflation. So they want to keep the inflation on track, and hence they brought forward the deadline to August 31st.
How do you rate the success, especially when compared to 2013?
Yeah, so in 2013, we could able to collect about $34 billion. It's already more than double of the same. So to that extent, it's been a unprecedented success. The diaspora love India, and they have always responded to such opportunities. And we've seen good momentum, good flows. In fact, the last week alone, when on August 14th, RBI announced the brought forward by 1 month, we collected almost $13 billion in the last week itself. So with one more week to go, I think we should be able to garner another 10 to $12 billion more. So to that extent, the response have been phenomenal. The situations are a bit different if we compare it with the 2013 versus now. 2013 was more reactive. We've already seen rupee depreciating by 15 to 20% from June to September, and that triggered 3-month scheme. That window was September to November, 3-month window, and that time we could able to get about $34 billion. This is less than 3 months. We are already at $65 billion in FCNR deposits. So to that extent, I think this has been a great response from the diaspora.
Dhiraj, apart from the impact on the rupee, do you see it perhaps impacting other aspects of banking in India?
See, even on the rupee, the impact would be only transitory and tactical, not going to be a sustained impact on the rupee as well. We see a range of 94.5 to 97 INR USD. So that's where it is. It may, because we got the liquidity, it will impact to stabilize a little bit rupee here, but I think the rupee will largely be dependent on the West Asia crisis and crude prices, and it would be elastic to the different variables rather than just the flows. We got greater comfort now with the 680 billion USD as reserves, forex currency reserves, but my take is that the long-term impact on the rupee would not be measured through just about the flows from the FCNR deposits. If we look at the impact on the NIM, I think it'll be just about a NIM compression for the banks, about 3 to 12 basis point, that too only for the short-term period. And also, my take is that the 10-year yield would not have significant impact. It'll harden. It's already hardened by 10 basis point. So beyond that, I don't see a major impact on the 10-year yield and on the rupee INR relationship.
You got to wonder whether the Indian banking system is getting too reliant on the FCNR for liquidity, I guess, support.
I don't think so. That's a right interpretation. I think domestic liquidity have been pretty comfortable in India. This has added to the liquidity for sure, and that would actually put a pressure on a little bit on the inflation side. The scheme have been well crafted by the central bank. No CRR and SLR requirement, which means that 100% of the money can be deployed for lending, and also it excludes from a priority sector lending. So to that extent, banks can lend it to the higher yield assets immediately. So I don't think so Indian banking system relying on the FCNR deposits for the domestic liquidity. It's more got to do with the stabilizing rupee and beefing up the forex reserves so that we can deal with or navigate the unprecedented increase in the crude prices, and also if there are negative impacts of the West Asia crisis.
But Dhiraj, you said earlier that the rupee is pretty contingent on the Iran war, developments of the Iran war. Given that there's so much uncertainty still, what's your own projection of where the rupee is headed?
You're right. The rupee is contingent to what will happen and what's happening in the West Asia. If we have a sustained pressure coming on the crude prices and higher inflation across the world and imported inflation because we import large part of our oil requirements, and if that can bring in more inflation, that will have an negative impact on the rupee as well. That's where this scheme was brought in, so that we can beef up our forex reserves and can deal with the short-term volatility if needed to be. So rupee range, as I just mentioned, we look at it 94.5 to 97 INR USD range. I think that's something which is where we have a comfort.
Dhiraj, I want to talk about the closing auction system. Why so many issues, you think?
See, in India, we were earlier having weighted average volume-based method for closing price. A lot of foreign portfolio investors were looking at, closing auction in line with the rest of the exchanges in the world. That's where Indian regulators responded to the requirement of foreign portfolio investors, and it is largely done to arrive at a closing price which resonates with the markets and reduce the tracking error for the passive funds. So it's early days of implementation. It's taking some time for people and stakeholders to understand in detail. So now we've introduced a closing action between 315 to 330. Yeah, so that's where the price discovery is. People are used to the older version. I'm sure they'll get used to the new version, and whatever teething issues and noises we are hearing about cash will fade away soon.
Dhiraj, very quickly, are there other challenges that need to be ironed out?
In the cash, I don't see significant challenge. I think there were concerns on whether one can accept aftermarket orders between 315 to 320. That's something have been absolutely made it clear. So we are all accepting now even aftermarket orders, and the price discovery is done between 320 to 330, and markets are getting closed randomly anytime after 328. That's perfectly all right. It's in line with what's happening in the rest of the world. And it's actually, people are, for the foreign portfolios, are happy with the same.
Dhiraj Relli, HDFC Securities MD and CEO, we thank you so much for your time. Subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any of the securities or Bloomberg functions we talk about and become part of that conversation. Do send us instant messages. Check it out, TV Go. And that is it for Insight. Horizons Middle East and Africa is up next. This is Bloomberg.